Good afternoon, everyone, and welcome to today's Payments Association webinar on the future menu of cross-border payments, fiat, stablecoins, or a hybrid. My name is Kate McKenzie. I'm Head of Production at the Payments Association. And before we get started, I'd just like to go over a few quick things. You can submit questions to today's speakers at any time by submitting them via the Q&A tab in the control panel at the bottom of your screen. They'll be addressing these towards the end, but as you think of them, please send them in. You can ask questions anonymously if you do not want your name attached, but obviously please don't go too rogue. We prefer if you send them in via the Q&A box rather than the chat. It just makes it a bit easier for everyone to keep on track. If you have any technical issues during the webinar, please feel free to send a message through to myself or Aisha Warris from the Payments Association, and we'll get back to you as quickly as we can. This webinar will be recorded and it will be available on demand afterwards. We'll send a note around about that after the webinar. I would now like to introduce Ruth Randhofer. She's an author, speaker, and an expert on the future of the digital economy, and she'll be leading today's panel. Over to you, Ruth.
Thank you very much, Kate. It's a great pleasure to run this webinar today, and I have an incredibly interesting and illustrious panel I'm glad to introduce right now. First off, we have Gary Palmer, who is the CEO of PayAll. We have Will Lear, Director of Product Management at MasterCard's Move section. Kamal Kishore, the Group Head of Strategy and Insights at PXP Financial. And Eric Quetham, co-founder of Velocity. And let me now introduce the topic a little bit more in detail. I think it's fair to say that we've seen an incredible acceleration of innovation in the last decade, and certainly explosions of new asset classes, crypto, stablecoins, digital assets in the last few years alone. The big question is always, is there anything in that technology innovation, whether it's the asset class, the digital ledger itself, or the software around it, that makes life easier when we think about cross-border payments, which is really a critical element of the global economy because it allows value to move. Maybe as a little caveat for anybody who's not a payment expert, money really never moves. It's always data. If we think about sterling, for example, sterling can physically move across borders in my handbag. However, the police may stop me if it's too many sterlings. But what doesn't happen is that sterling moves from a UK bank into a US bank, even in digital format, because currency never in a digital form leaves the country. Sterling is issued, of course, by the Bank of England. It's a liability of the central bank. And banks are holding this money in their own digital accounts in the UK. And if a UK bank needs access to a US dollar money vault, they have to go to a US dollar bank and basically borrow that money. And there are transactions done between institutions to facilitate for this foreign exchange trading, but the money physically and even digitally never really moves. So I think that's quite important to understand before we get into the meat of this. Now, the most important movement or non-movement of cross-border payments in the business space when we think about large transactions between businesses to supply goods from across borders, as well as if we think about banks that borrow and lend each other foreign exchange currencies, those transactions have traditionally been executed via correspondent banking, which is a very distributed and decentralized process of banks that are connected together via a messaging framework provided by SWIFT in the majority of cases. And these transactions work fairly well for larger businesses. They have been accelerated over recent years with the Global Payment Initiative, but they're not necessarily an efficient means to get cross-border payments executed for retail or smaller SME customers. And so for years, we've been trying to crack the remittance problem. You will be aware of the G20 recommendations and rules from the Financial Stability Board around making sure that those cross-border transactions become more efficient and cheaper and faster and more transparent. Those deadlines are looming now with 2027. Unlikely that the majority of providers will comply to these because it is a challenge. And more recently, we've seen the use of crypto and stablecoin, both in cross-border remittances and increasingly in SME payments. We've seen retail and business banks looking at crypto type asset classes as additional instruments to offer to their clients. But we are still in the early stages because what we don't have until today is a global payment system. We have this fractured correspondent banking system, and we have quite a few challenges in this space, particularly as it comes around to anti-money laundering rules and know your customer rules and all the risk paradigms associated to that, regulatory fines, which we know throughout the last decades that are increasing. And therefore, in the absence of a global payment system, but with innovation that we're starting to see potentially across rails and infrastructures, certainly in the software space and in terms of new digital asset classes, the big question really is, do we see some innovation that will meaningfully change this ecosystem to make it more transparent, more efficient, and allow businesses to transact more efficiently? Certainly, Swift is trying to catch up here and has announced recently at Cybos that they're building a digital ledger for banks to connect to allow the combination of digital assets and information to flow together, which until today is not the case. But let me now start our conversation with this panel here to really look at the key root causes that we still see today with cross-border payments. Is it foreign currency liquidity and cost? Is it regulation? Is it general risk on counterparties or systems, or even cyber risks? What are really the big issues we see today in the market that are still making this such a complex system? And I think I'll start maybe with Gary to look at this particular problem. Gary.
Thanks, Ruth, and it's a delight to be here, everybody. Just a comment from the beginning. I've been an advisor to the Philadelphia Federal Reserve Bank since 2005, but my comments today are not from the Fed. They're my personal comments, either from the Philly Fed or anyone at the Fed, as well as having started Payall. And I also want to say, this is not an advocate for any technology or outcome, but really a direct answer to Ruth's question. I think all of the points that Ruth raised in terms of concerns about transaction risk, counterparty risk, money laundering, data sharing, local compliance, multi-jurisdictional compliance are all factors. The single biggest factor is, in order to improve the user experience, and this is one of the areas I think that I'm focused on, is how do I make sure that our customers, our banks, our EMIs can deliver great user experience. It's actually the safe and transparent and fast delivery of funds. And in order to do that, it does require a different mindset around ledgering. And Ruth absolutely nailed it. For 50 years, we've been dealing with a very disparate construct of cross-border payments, where they're an originating institution, sign up with a correspondent bank, either by virtue of their own capabilities and assets or by virtue of intermediate banks, can provision liquidity in various countries around the world. But in order for those balances to move, in order for the money to move, there have to be debits and credits to ledgers. And these have all been disparate, one-off. Many in the past haven't been real time. And so that's sort of the history. And there are two ways to fix that. One is DLT or blockchain, where you have a distributed ledger. And I'm not going to get into the pros and cons of that, but that's one way to fix it. And the other is what's called a single shared platform. And this is the foundational architecture used by the Federal Reserve in the US, the ECB in Europe. And our take is that single shared platform can be global and multi-currency, where it's a single source of truth and a ledger that sits independent of the local core bank systems, but A, is connected to every core bank system through real-time APIs, and B, may be directly connected into the local payment schemes to allow for access to the real-time payment rails that now exist that didn't exist 10 years ago. So it's a combination of technologies that we see will help, or not combination, but it's two different types of technology constructs that can overcome the historical inefficiency of cross-border, DLT and blockchain, and then a global single shared platform. They're not mutually exclusive. They don't compete with each other. The market's big enough, but there are pros and cons of each one.
Excellent. That's a really good perspective, because for long periods now, probably more than 10 years, people have been preaching blockchains to be the answer to everything. But I think what people haven't really focused on is to look at the challenge of data and KYC and compliance, which really is the Achilles heel of the banking industry at large. And as long as this remains the Achilles heel, you can almost deduct that any innovation that builds on top of it is equally going to be challenged, because if that's not fixed, you have a problem, as other institutions more outside your banking ecosystem are relying on the banks to do the right thing. And I think that's where maybe the big challenge comes from. Who else would like to maybe comment on some of the issues that we see in the market? Maybe Will, from your experience?
Yeah, no, happy to touch on that. So I thought it was interesting that you mentioned Swift GPI. I used to work at Swift and was part of the team that helped take that to market in North America. What we found, obviously, with this Swift network and what the perceptions are in the industry is more related to the fact that banks and payment systems aren't operating 24/7, 365. And so even though the messaging layer that creates the instruction, defines the travel rule requirements, sender address, beneficiary address, all the important information that you need to send and execute a cross-border payment, that happens through the messaging channel. And that happens fairly instantly. Now, if that message is sent to a financial institution and it's midnight local time, obviously they aren't going to be able to process that immediately. And that's for two reasons. One, it's related to their internal systems, right? So being able to credit the account of their internal ledger and then being able to forward that on into the local system. Until the operating hours of the bank and of the local market infrastructure are open and running, you're always going to have that challenge. And until every bank and every local market infrastructure gets 24/7, 365 access, you're always going to have that issue. So that's, in terms of a messaging and settlement perspective, I think that's a huge challenge that the industry has been trying to overcome. But back to your question on what makes cross-border payments so hard, I think at MasterCard, when we talk to our customers, because we service customers all over the globe in pretty much every region of the world, the use case and the challenges that each of those specific customers experience are going to be wildly different. So if you are a US-based corporate trying to do an intra-company cross-border payment to Europe and you're using USD and euros, it's a fairly simple and straightforward transaction in a corporate me-to-me context. But if you start to talk to financial institutions that are trying to service remittances in the UAE, for example, and the payment is denominated in US dollars and wants to be pushed all the way to the Philippines, right? You go back to the challenge that I mentioned before related to the operating hours conundrum. And then on top of that, it's the access to that USD as well and the cost of accessing that correspondent banking account. And then there are also very exotic examples that you see in the industry, a SME supplier in West Africa trying to pay a Chinese exporter. So that's particularly challenging as well because you have to deal with beneficial ownership. You have to set up a bank account. Getting access to that USD is particularly hard. And so the area is obviously ripe for disruption, but going back to trust, compliance, all of those elements, those are a core foundation that make the industry and the system itself safe. So, if two participants are able to pay each other without knowing a lot of elements on who they are and validating that, name it matches account, that could be solved on the blockchain, if you will. But there are a lot of elements that have to be fixed in order to create a trusted system that doesn't really exist today in mass.
So you got me thinking here. So one point which is really important for our audience to retain here is that the banking industry and the financial system industry doesn't operate 24/7. We still have time zones, even though we feel very globalized, we are not at that level, which is also the many-year-old discussion around RTGS opening hours that are still ongoing from that perspective. I think the second thing that came out quite clearly here is that I think when we look at those innovations of blockchain, Bitcoin, distributed ledgers, a lot of it was really initially retail consumer usage mindset. And I think it comes from the mindset, oh, I'm paying my friend down the road 10 quid, right? Which is, of course, a bearer asset instant transaction. And applying that mindset to this peer-to-peer world where things should be as seamlessly as me paying somebody 10 quid on the road, it seems to be still anchored in that emotional, this should all happen real time and really quickly and without friction. And this can't happen in any institutional context, but even in retail payments, you need to still make sure that there's no terrorist financing going on, no money laundering going on. So we have now global regulation, despite incoherent and not necessarily commonly enforced, that are setting standards higher and higher at that level, which is why infrastructures and processes need to embed all of that too, and can't just be done in this sort of old way of I'm going to pay my friend 10 quid down the road. So I think maybe that is one of the big challenges as we look at this. I just came from teaching my students here at Base. And the other thing is, of course, that if you think about GDPR, the General Data Protection and Privacy Regulation in Europe, the way blockchains are designed in terms of transparency and lots of data are totally in conflict with GDPR, which is about data minimization, right to erasure, deleting traces on a ledger, which is exactly where the blockchain hasn't been designed that way. So we are already entering a world of hybrid designs, private data offline in encrypted forms, etc. But that is maybe an aside on that level. So that means that certain of these innovations are really not mature yet from a real application sense. I think if I look at maybe Kamal, in terms of sort of your client base, do you see a significant shift in terms of challenges that exist in cross-border payments and clients seeking alternative solutions that they feel are tackling those challenges more, or is everything a little bit same?
Yeah, 100%. And thanks, Ruth. I'm very happy to be here in this panel. And so going back to your question, I think, the client base that we have is kind of very diverse. We're looking at some retail to hospitality to some high-risk merchants in the gaming sector. And I think, the kind of portfolio that we have varied risks. And depending on the risk, you need to have your KYC and KYB due diligence completed. And I think that presents a challenge in how you deal with that. And of course, comply with all the regulatory requirements. So gaming sector has been very open to using CBDCs, blockchain and all these technologies. But when we go back to the hospitality retail, I think they are still very much traditionally focused on using fiat. And what I think as a business we would like to see is, we have a multi-rail system which can offer diverse solutions to different client base.
Excellent. So there are different solutions for different use cases, but also the risk appetite
Absolutely.
is quite different across industries. And I know I talked to you before, even around gaming. You may think gaming is quite reckless, but actually the industry is highly regulated by now. It has to
Absolutely.
be also very careful around adopting new types of solutions that have to be equally sound when it comes to compliance and other aspects, right? Okay, that's
That's right.
important to underline. Now, clearly we've seen anything but short of an explosion of stablecoins in the last year. You just have to look at the stats of Tether growing, I think from 3 to 6 billion or something. I had it this morning on a slide, but we have significant growth of stablecoins, which are clearly in part fueled by the US starting to regulate this market. In Europe, we had already MiCA for the last 2 years, regulation obviously still being embedded. But the fact that the US came to the fore and recognized that stablecoin issuers need to be stable, they need to make sure that they redeem money at par value, they have to have backing with actual US treasuries or cash equivalent. The whole system has to be made safe and accountable. And it's very much sort of almost innovating on the existing e-money laws we know from 2001 in the European Union. So there's nothing really much new under the sun, but certainly having the Genius Act now there, albeit not implemented, is a step forward, and I think is certainly starting to suggest to the user community in some areas that this becomes a potentially more viable option to use. My point is always the caveat that supervision has to be effective and has to be acting as a deterrent against bad behavior and non-compliance. We'll get to this when we get to it. We are not at that stage yet. But given that we have Eric here, who's obviously the co-founder of Velocity, that is a stablecoin platform, I'd be really interested to hear from you, Eric, around, do we see any challenges? I mean, clearly we have conversions between fiat and stablecoin. We don't really have ubiquitous regulation and supervision. And we have lots of other questions around this space. Do you feel that stablecoin is a panacea, or is just yet another thing that we will need to mature across different dimensions to make it really work?
Everyone, thanks for having me. I do. I mean, I couldn't be more bullish on the implications of stablecoins in both banking, treasury, and payments going forward. I think the panel here has touched on a bunch of things already. I think first and foremost, this topic of being able to support the same standards of KYC and KYB and AML. I think the reality is of stablecoins is they require the use of banking rails today, right? There has to be some form of on and off ramping capabilities. And because of that, you are effectively being asked to be held to the same standards of what those banks are requiring, right? So when I go out and I onboard with a new bank, that bank is looking at those policies and bringing me into their ecosystem in the same way they would any other payment service provider, kind of within the industry. And so I think you're now starting to see kind of the mainstream requirements of traditional payments move into stablecoin providers like ourselves. And so I think, the risk or concern that people are going to emerge and operate in the space and do so kind of in the shadows without, following the same regulatory requirements that have always existed for other payment institution organizations, I think is probably not the case anymore. So I have kind of less concern about that. I think the one kind of big use case that necessarily hasn't been hit on with this group so far is there's a lot of organizations and individuals around the world who would love access to a more stable currency, right? And so the reason why Tether has gotten so big and the total stablecoin in supply is now about 300 billion. And Tether and Circle and USDC are largely a duopoly in that space. And they're serving very different use cases, right? Tether is providing access to the US dollar in a way that wasn't possible for both countries and organizations, either residing in places that had strong capital controls or just didn't have banking infrastructure to get them into a currency that allowed them to operate the business in the way they wanted. And so I think that use case is incredibly powerful. And I think it's an entire different lens on the use of stablecoins, right? It's effectively giving people the ability to stabilize the underlying backbone of how they're operating their business, how they're paying their employees, and what they're doing, right? And so I think that use case is hard to imagine a bank or a set of banks solving for, right? And so that is a use case that I think is far in a way the early kind of winner within stablecoins and will continue to proliferate and be a massive opportunity, which is why I think you're seeing, Tether out in the market raising at $500 billion valuation and raising $20 billion, right? They're doing that because the world believes and very smart investors believe that there is enough demand to get access to the US dollar via this instrument, right? I think the other use case, which we've been talking a lot about, is just payments related, right? And I think that frankly is one that the banking world could choose to solve, right? The issues that we're hearing from customers and why they want to use stablecoins is they want to get rid of pre-funding. They want money to move in real time, and they don't want to pay egregious FX or corresponding banking fees, right? Those three are all actually within control. And I think technology to solve those is not so complicated that you have to invent something new. I think the problem you have is you have a set of incumbents who have grown up generating meaningful economics on those three things. And therefore, particularly in this rate environment, and therefore it's pretty hard to imagine them basically ceding or beginning to significantly compress themselves on the economic side. And so I think more than a technology debate, this is actually coming down to economics and where the economics flow. And you have incumbents, including Velocity and others who are now in the market who didn't grow up, sitting on people's balances and not paying, market rates. There's $200 billion sitting in business bank accounts in the UK alone today, earning zero interest. Like, let that sink in, right? There's $8 billion a year of interest income that could be going to businesses that is sitting with banks because they've made it too complicated for those businesses to move into money market funds or to other things. And so I think the whole kind of underlining aspect of stablecoins is that they're disrupting the economic model of how banks have traditionally operated. And I think the tension now is like you have wonderful organizations out there trying to work with banks to solve the technology side, which I think is solvable. I think for me, the question is, will they ever get there on the economic side? And I think the answer for me is probably not fast enough before stablecoins become mainstream.
Right, Eric, that you've given us incredible amounts of food for thought here. I think maybe just for our audience, the first point around access to US dollar is indeed the critical stablecoin use case. And that used to be the critical Bitcoin use case, which is, of course, why El Salvador years ago made Bitcoin legal tender. And then when they needed money from the IMF said, I'm only going to give you money if you go back to your shitty local volatile currency. And as a consequence, and funnily enough, Tether is headquartered in El Salvador, no coincidence there. But the reality is, of course, access to US dollar for countries that have incredibly volatile and underperforming economies is still a big thing. It creates sort of challenges geopolitically in the sense that there are a number of countries that want to move away from US dollar hegemony. This is, again, a very different topic. It's not about payments. It's about geopolitics, about balance sheet. I think the only thing I'd like to caveat is the size of Tether and Circle in terms of big US dollar issuers for stable coins is really significant when it comes to the equivalent treasuries that they're holding as a consequence in the US. And this could inadvertently become a real problem for US budget perspective if anything really bad were to happen to either of those networks. If there would be some sort of collapse. I mean, today we discussed the fact that AWS went down in parts of its segmentation, which was a huge issue for a number of global companies in the last few days. So you have the cloud concentration, and that wasn't even a cyber attack. You have cyber attacks. You have other reasons where something could suddenly not perform and go down. And if that were to be resulting into a run on stablecoins to get back the fiat, you would have a knock-on impact on US treasuries. And that is something that people will need to navigate very carefully because of the scale and size of this. It is, of course, a very comfortable position to be in when it comes to getting more US dollar funding for the US government, but it can equally backfire if things go wrong. But let's park the US dollar kind of access side on one side. I completely agree with you. It's not a technology issue primarily. In fact, a lot of things are never technology issues. They're issues of vested interests. They're issues of elements of regulation, supervision, and consistency and coherence. We are still in an incredibly fragmented global regulatory environment when it comes to anti-money laundering, know your customer compliance, despite FATF rules. Equally, we have challenges, of course, when it comes to cross-border execution, including with stablecoins. If something goes wrong, which country law applies? Nobody can answer you that question. And if you were to use some of these tools for payments, if you were end up holding them as a business, you also have to look at tax implications and equally for consumers. But I think the whole ecosystem is a little bit more complicated. Because if you only look at the payments case, you can also equally look at the fact that we have Nexus coming along with the interconnectivity of instant payment systems. I think you see a lot of innovation in the interoperability space. And you see a lot of innovation in that overlay compliance piece that Gary mentioned around having a single source of truth platform where people can hook up to and connect to their local payment system and connect with the data into their own internal system to get more data flowing. It doesn't take away the 24/7 operating hour problem, but it certainly will automate a significant piece of challenge that today is an economic challenge for cross-border payments in many markets, which has, of course, resulted in de-risking. So I think we are still maybe early days on that journey, but maybe coming back to Gary, having heard what Eric said and really maybe focusing primarily on the payments use case, because that's the topic of our conversation, And how far do you see that your approach is really sustaining the existing banking industry to make life easier and more efficient economically, and also maybe reduce some of those 24/7 implications we discussed?
Well, first, just to say this, I think one of the challenges when we talk about stablecoin, it's the variety of use cases and the problems that are being solved. And when we think of stablecoin, or we think of it, we all come at this from a certain perspective of a particular use case, and they're all very different, which means the problems being solved are very different. So, for example, one of the early use cases of digital currencies was really the collapse of the availability of correspondent banks providing cross-border payments to originating institutions. I mean, for over a decade, from 2011 to 2021 or 22, there's a 25% reduction number of correspondent banks. So if you were a business and you went to you were at your bank, they couldn't offer a cross-border payment, and the banks couldn't get correspondent banks to help them. So being very focused on that use case and not talking about some of the, I mean, Eric's business is exceptionally well positioned to address treasury payments, wholesale, some of the larger aspects of payments, focusing on that versus holding dollars, which is incredible. But if you're a small bank in the middle of somewhere and you can't get a correspondent bank to help you make cross-border payments, you're going to lose your customers. So you have to find a way to do that. And you can say, well, we're going to pivot then over to stablecoin, or find a stablecoin issuer or partner. The stablecoin partners, as Eric said, still have to have a bank that does business with them. So they still have to go through due diligence. The bank still has to make money on that relationship and on that transaction. Someone still has to provision capital if there's a one-to-one relationship between all the stablecoins that have minted. So there's still deposits, there's pre-funding by someone. So a lot of the underlying economics or the foundational elements don't shift. It's just who's paying and who's earning. And I think the argument, or part of our point is that the reason, if correspondent banking and cross-border payments was so profitable to banks, 25% of them wouldn't have left. The issue is that it hasn't been profitable for most of them because they didn't have the right software to digitize counterparty risk, transaction risk, real-time funds movement. It wasn't profitable.
Sorry, you broke up a little bit, Gary. I think you're coming back now. Just repeat the two.
Well, it just wasn't profitable for most correspondent banks, and that's why they left. And those that stayed, even though they're generating a lot of revenue, their profits are questionable because of the volume, the amount of people committed to sustain those businesses in the absence of software. So I think that what our position is that we are here to help financial institutions address both. If they want to maintain the existing status quo of how they work with correspondent banks or how they access cross-border payments, again, focused on that versus, say, treasury payments through companies like MasterCard Move and Visa Direct, we're going to help with tech. On the other hand, if they want to make a digital currency a part of that, that's terrific as well. We're going to help with that. So what we're trying to say is that the infrastructure elements, the compliance and risk elements, whether it's a stablecoin issuer or a crypto wallet operator or the classic correspondent banking, a lot of that doesn't change. And there is capital on deposit somewhere, but who's earning the interest on it? How's it being shared? We also have to keep in mind how artificial is the current environment given the interest rates being paid on that's available now. So there are a lot of moving parts here. There's no like one right answer, one wrong answer, but we've got to be mindful of other moving parts. Make sure that if you're a financial institution, you're working with a stablecoin issuer, be sure they've got excellent KYC, AML policies. Because if you're a bank and you're supporting someone who's not doing those things well, it's unproven, it's untested yet in the legal market, in the courts, who's going to be responsible for that? And like any system of compliance or regulation, if you've got garbage in, you've got garbage out and bad decision making. So software at the point of entry into whether it's a bank or initiating a stablecoin transaction related to the identity of the parties, the reason for the payments, the economic legitimacy of the payments, who the recipients are, all of these elements have to be addressed, whether it's stablecoin, whether it's fiat, they don't go away. And our argument is that the banks have struggled to get this technology right. And it's one of the reasons we've seen a collapse in cross-border payments through correspondent banks and the rise of stablecoin alternatives.
Thanks, Gary. But I guess, I mean, stablecoins don't fix the compliance problem, right? It's just if we're actually ignoring compliance and sort of potentially moving the risks into a less visible area, right? Maybe just to follow up on that.
Well, we just have to fix it. I think the point is that whether the funds are moving to a stablecoin issuer and transactions of that nature, or through fiat, through banks in the old-fashioned way, addressing compliance, addressing terrorist financing, anti-money laundering becomes central. And we can't forget, we want to gloss over it, but we can't forget some of the earliest use cases of Bitcoin were to overcome countries that have sanctions, or to overcome, there's a long list of, when you look down the top 10 use cases of Bitcoin in the early days, it wasn't for all the golden things we're talking about that Eric's doing. I mean, Eric is absolutely on the right-hand side of the angels here, trying to solve a big problem that failures at banks or their technology providers innovate create an opportunity. But when you look at the original use cases of Bitcoin, it wasn't so beautiful.
Well, and I might just add, I mean, stablecoins until today, also the majority of use cases is to breach sanctions and violate anti-money laundering rules, etc. But again, I guess the hope now is with more regulation and hopefully adequate supervision, which is still, the jury's out on that, with that coming really into play. At the moment, this suggests to users that it is safe already. It's not necessarily safe, but it should become more safer and better regulated. Now, coming to Will, if we think about both stablecoin payments and where you see those appearing versus maybe other hybrid models or interconnectivity models, given that MasterCard is very active in the infrastructure world as well, give us a few views on what works today, what doesn't work, where are the gaps, and whether in parts infrastructure can also play a role to support.
Yeah, so MasterCard Move today does payouts all over the globe instantly to many markets. We reach to over 200 markets around the globe. We can do payouts to bank account, mobile wallet, cash pickup, and card. And that's our core offering that we use to help financial institutions do their disbursements and remittances around the world. And that's pretty much in the what you'd call the TradFi ecosystem that exists today. Now, when you think about some of the elements that Eric had talked about earlier when it comes to how does that all work, right? There are elements of, depending upon where you sit in some of those transactions, generally in cross-border payments, you could be pre-funding, or if you're lucky, you could be, post-funding in each of those scenarios. And each of those chain hops, depending upon if you're a pre-funder or a post-funder, you have a different burden that sits upon you. And then on top of that, you have to think about how fast it can be to reach that ultimate beneficiary endpoint. So when we think about the opportunities for stablecoins, there's obviously the treasury function that exists, where if you're pre-funding and you have trapped liquidity in all of your providers, I mean, think about correspondent banking. We'd like obviously go back to cards, but imagine if you have to do payouts everywhere and all you're given is prepaid cards. So if you have a prepaid balance at Best Buy, a prepaid balance at Amazon, and they're all sitting in these cards, well, you have to use them up in order to reduce your balance, and that's all you have to do your payouts. It can be very challenging because you're focusing on forecasting. How many TVs am I going to buy from Best Buy? And again, this is just an example to kind of paint the picture. But that pre-funding challenge from an institutional perspective is incredibly cumbersome. And so the opportunity for stablecoins is potentially being able to reduce some of that pre-funding liquidity burden, being able to do instant payouts or funding to your providers that you have around the globe. And I think that's one of the things that we're looking into and for MasterCard. And then on top of that, us being able to leverage those stable coins in treasury management with our partners that we have around the globe in order to enable those transactions. And then thirdly, there's the element of being able to pay out directly to a wallet, which goes back to the KYC issues and implications. So depending upon where you sit in each of those three scenarios, the use cases that are relevant will vary, right? So for customers that are pre-funding, if they're sitting in a time zone that is in the Far East and they have to pre-fund in US dollars, right? They might have to send, if they're trying to give their customers an instant experience, they'll have to pre-fund a day in advance in order to service next day's transactions. And the forecasting in order to make that happen in terms of FX volatility, being able to manage your balance sheet, et cetera, that's incredibly challenging. And so again, the time zone element, especially on the pre-funding side, is a huge benefit if you are, going against the sun, as we say. And then on the payout side, the use cases vary, right? So again, back to what Eric was saying, if you are trying to inflationary hedge in markets like Argentina or Nigeria, or maybe there's a lot of crypto activity, so maybe you can get FX spreads that might be tighter, working with exchanges that are constantly swapping out these stable coins so that customers can ultimately buy crypto assets. Like maybe there's more liquidity in certain pockets. And in those markets, we've heard from customers are trying to explore those liquidity opportunities to get an arbitrage, if you will, on certain market payouts from an FX perspective. But it still goes back to, okay, well, even if I can get that better FX and or if I have access to a stablecoin and I can push it all the way to the beneficiary, if that beneficiary is a grandmother in the Philippines that's trying to buy her groceries, she doesn't want a stable coin, right? She wants her local currency. And that's kind of goes back to where MasterCard Move is very strong in being able to deliver to these fiat core payment methods and acceptance methods that still make the world go round, right? So when we think about the core use cases, we still see on the beneficiary side, unless you have key pockets like this inflationary hedge perspective, people still want cash. People still want to pay their bills. People want to still pay their suppliers. And so I think those use cases are relevant when asking the question on that use case, is stablecoin relevant? And in what part of that hop is the stablecoin relevant? And I think that's what we're thinking about most today.
Yeah, so that is actually very clear for the audience, because despite all these multitude of use cases, which could be economic, geopolitical, freedom related, paying the local groceries in cash, every use case has a different combination of the value chain that you ultimately go for, which is a tricky thing in itself. And I guess this is where businesses like PXP or banks and other entities help to provide more clear menus for their customers so that they know what's going to happen, at least to a certain extent. But the flip side is, of course, also that 24/7 is not there. And I think when we think about 24/7 stablecoin versus non-24/7 old world, there are also inconsistencies around risk management, where something could happen during 24/7 hours in the stablecoin world, which happen when banks are closed. And when the bank opens, suddenly something else is there than what they expected. So the risks can again vary because these two systems or these two worlds are not yet aligned. And I think this is something where I think more time needs to pass, more regulation and certainty and standards have to happen. I think what is a huge problem is this just-in-time funding, which is, of course, global corporate treasurers hold thousands of accounts with banks and they're all full of money. And the banks themselves, out of the financial crisis, were required to hold back capital for these types of transactions because they're considered more risky. And that has made it, on top of the compliance on AML and KYC, a lot more expensive to run this business, which is why we have the de-risking that Paul mentioned earlier. So just to say that I think the just-in-time element is something where I'm wondering from an infrastructural perspective whether we could also replicate that in the interconnectivity of instant payment systems, potentially, in order to have regulated payment systems that obviously then allow for more just-in-time funding. Is that something you would have a perspective on, Will, from?
Yeah. So again, I think being able to do that just-in-time funding is relevant especially on our originating institution side. And so when you think about being able to potentially leverage these real-time systems, there's definitely a trade-off that comes with the operations that happen from a sending instruction perspective. But again, if you have two markets where there's real-time payments in the sending market and real-time payments from a market infrastructure on the receive market, right? There are schemes that are out there today that are like SEPA, for example, who are doing a great job of trying to bridge that gap, because once the funds itself leave that system, you have to be able to understand what the rules are in the receive side system. And so as you think about these real-time payment system islands that exist all over the world, being able to connect them all is particularly challenging. And I think that's one of the things that MasterCard is also focusing on with some of our real-time payments initiatives. But again, the rules and the scheme set that exist in each of those islands is particularly challenging to map against, and that's what Nexus is also looking into from a global payments perspective. But we feel that MasterCard has a strong role to play in bridging all of those digital islands, if you will, from a scheme management and mapping perspective. So in a way, if that continues to grow, right, maybe there's a challenge to some of this on-chain infrastructure, because again, the existing infrastructure has that stuck cost of, I do this today, I don't want to have to change my the way that I do business. I don't want to get a mobile wallet. I don't want to get a crypto wallet. I don't want to manage key infrastructure. The complexity of changing to the new system for the vast majority of people is going to be too hard. And so as these systems upgrade themselves, they're really fighting for the ability to retain their existing customers rather than forcing them to jump into something new that is a huge leap.
Gary, you had
I want to jump in and to connect two dots. One is to make very tangible some of Will's conversations, and at the same time, Ruth, punctuate how MasterCard deals with some of the absences or the gaps of 24/7 systems. This is a true story. 2 years ago, we did a demonstration for a US bank and another American bank who's buying services from MasterCard Move, using us as their processor. It was 7:02 p.m. on a Friday night on the East Coast. So the banks are closed in the US. We convinced the CEO of this prospect bank to join a demo call at 7 o'clock. So he said, you got 10 minutes. So 7:02, we said, we're going to send €5 to Portugal. And he said, why are you wasting my time? I process through XYZ correspondent bank in the US today. If my customers at 7:02 p.m. sent €5 to Portugal, it would get there on Tuesday and then get negative €15 in their account, because the Portuguese bank is going to charge a €20 fee for receiving international wire transfer. By the time he finished complaining at 7:06 p.m., 4 minutes later, the recipient in Portugal held up their mobile phone and showed a deposit of €5. So that was 6 minutes past midnight on a Saturday in Portugal when every bank system was closed. But MasterCard Move has recognized the inefficiencies of all of these systems, as did we, and built solutions to overcome them. There is no stablecoin alternative that could deliver funds so quickly from one bank account to another and deliver the full €5 as efficiently in that specific use case. That's not to say there aren't great, compelling use cases for stablecoin. There are, but we have to be very nuanced, A, about the use cases, and B, what the alternatives are that exist today, like MasterCard Move. And it was super easy for that bank in the US to adopt MasterCard Move and to offer this great service to their customer that they've never been able to offer to any customer before through a correspondent bank, through classic correspondent banking, or through a stablecoin issuer.
Yeah, that's really helpful. And again, as you say, it's very specific use cases. I'd like to quickly, because I see it in the chat, to get one questions answered, which is for Eric, I think this one. What are the real cost benefits of stablecoin usage? Is it in the rails, the settlement, the foreign exchange? the correspondent banking avoidance. Where does the actual cost efficiency mostly come from? I mean, the idle balances potentially. Eric, would you like to explain a little bit around that? Maybe SME versus global corporate versus retailer for the payments use case.
Sure. Yeah, look, I think there's three main economic values that stablecoins. I think if somebody's moving to stablecoins, they're solving for one of these three things. I think number one is the time to cash. So in a lot of instances, folks are pre-funding. Let's say they're looking to do a payout in a country the funds need to land in a consumer account on a Tuesday. They're often taking out a credit line. Let's say these funds are originating in the US and going to a handful of countries around the world. They might be receiving these funds from consumers who are US based, going to consumers, so call it a peer-to-peer transaction, an international peer-to-peer transaction. So they might be using a MasterCard or a Visa issued debit card to fund that transaction on a Monday. The reality is that in order for that payment provider to get those funds to the end consumer by Tuesday, they're actually generally taking out a credit line from a large US bank at, call it 5%. And they're funding that transaction on a Monday in order for it to make all the relevant hops between Monday and end of day Tuesday in order for that consumer to get their funds on a Tuesday, right? So if the cost of capital, at the starting point is 5%, you can do some pretty quick math on what the cost of that transaction is to the end consumer versus a world where I'm actually working with this provider and they are still using the same acquirer they have, but instead of settling those funds into a random bank account, they're actually settling it into a bank account where I bank and where my liquidity partner or my stablecoin issuer banks. And so those funds arrive on Tuesday morning. I actually do a ledger move from their account to my account. I then ledger move those funds. This all happening in real time because it's in the same banking network. I move those funds to my issuer who instantly mints the stablecoin, moves them into a digital wallet. Those funds are immediately available anywhere internationally, and the off-ramping process begins to make those funds available in fiat for the end consumer, right? So in that use case, I haven't really done anything significantly to change the FX profile or anything related to the transaction, but I've saved them an entire day of pre-funding, of which they're using a short-term, credit line from typically a large tier one bank, right? So that's kind of use case number one. The second use case is where I have money often sitting in complex currencies that often have capital controls or other things that make it difficult for me to get those or make it costly for me to get those funds out of those markets, typically due to liquidity. And so my opportunity would be to leverage stablecoins to reduce the FX costs of getting from one currency to another. Now, I think a couple of years ago, when the depth of liquidity was fairly limited and where providers like ourselves didn't have access to trading desks at kind of tier one banks, that proposition was limited. I think given the size and scale of at least two major stable coins and the liquidity and the depth of liquidity, as well as the access that folks like us are getting to leverage very cost efficient FX desks, I think there's a lot more opportunity to arbitrage current rates that those enterprise businesses are getting from their local banks in order or other payment providers to move those funds. And then I think the third use case is where somebody might be picking up or moving funds on a Friday and sitting on those balances for a handful of days until they put that capital to work somewhere else. Sometimes, it's anywhere between a day to kind of 7 days, typically for a mature business. And during that time frame, they're missing out on the opportunity of earning any sort of interest or yield on those accounts. And so we're also seeing that as a opportunity where if you go to your bank today, and this is a great example, right? So we raised one of the largest pre-seed funds in European history earlier this year. We got all this capital come in from a great group of investors. We are banking with a very well-known global bank, and all this cash hit. And I said, "Hey, I would like to put this cash to work. What sort of products can you offer me?" And they said, "Well, we could offer you a 120 basis point product." And I said, "Well, that feels a little off, given that the market for a money market account is like 420 basis points." And they're like, "Well, yeah, okay, let me talk to my manager." And they came back and they said, "Oh, we can offer you 150 basis points," right? And immediately I said, okay, that's obviously not going to work for me. So I'm going to go put these funds somewhere else and, earn interest income on these funds. Cause obviously we raised money to, to burn for a period of time. And in the end, the process of actually sourcing a money market account, moving the funds out of that account into a money market account, and then knowing every month when I want to draw capital back into my account to meet my actual operating costs of our business was pretty complicated, right? And there was, several days lag in that entire process. Versus if I can move into stablecoins in real time and I can swap from USDC to AUSD, which is a Agora issued stablecoin, and I can earn a guaranteed yield or reward on that product, that actually application from a treasury perspective is much simpler. And particularly if in what we're doing is taking that account infrastructure and integrating it back directly into my TMS. And so that this becomes just yet another, it looks just like another bank account or just like another financial institution that I'm working with. And I think when those two worlds kind of come together in a simplistic way, and if the best opportunity is to earn 150 basis points on my money or spend 3 days getting it to a money market account with a traditional lender, and I can do it in real time on stablecoin rails, I think you have, real product market fit there.
Yeah. So we're running a little bit out of time, but let me just quickly surmise this. So in terms of that question that was asked around the stablecoin cost benefit, we talked about cost of capital, we talked about foreign exchange, we talked about yield. I think the other points Eric just mentioned is that the traditional banking industry is not really well geared to provide efficient products because they like to sit on money and not make it very easy. And unfortunately, unless that changes at some point, because there is pressure to make it change because those economic models no longer work, the change won't happen. I think it is, however, still caveated to the extent that stablecoins, of course, if you hold them as any business or any user, can attract capital gains tax, can attract property tax, can attract market-to-market requirements depending on the accounting and tax regime you're under, which means that whilst we start to see stablecoin use cases for cross-border, where stablecoin acts as an intermediary asset class in order to make this thing real time and remove that sort of hugely costly pre-funding, we are not yet at a point where we have global businesses holding stablecoins, unless they are holding those with full recognition of the tax implications as well, which is maybe something that SMEs might struggle. And we also have cross-border reporting obligations. So just to caveat that, one other question that was raised around the size of Tether and also the increasing size of Circle, the monopolies that is going on there, clearly that will require more cross-border regulatory dialogue. I mean, the weird thing is, of course, that Tether is headquartered in El Salvador. So El Salvador are the regulators without much regulation. They have crypto-friendly regulation in place. Tether will be subject to the Genius Act for any US customers that they're serving. So there will have to be that US regulatory dialogue. And of course, we have also MiCA in Europe in terms of the issuance there. So we do have various challenges from that perspective. But I do think when we think about maybe summarizing this a little bit, we are in the early stage of a new world. The new world is starting to become more viable for some use cases than others. I think what is really important is the use case itself. I do know that when you think about a cross-border remittance from UAE to India, stablecoin is often not the solution that is used because neither the user on the sending side nor the user on the receiving side knows what stablecoins are. The network in India is not 5G everywhere. People do want cash, back to the earlier example around paying for groceries. And so as soon as you have more intermediaries in such a increasingly complex value chain, you will have more cost. So I do think the economics of this use case as one of the examples will have to be very carefully assessed, really use case specifically, with all of those factors in mind. And there will be other factors in addition to that. I think what does, however, strike me is that the existing correspondent banking world, which is economically problematic, has huge regulatory burdens and other things, is still the backstop to all of these new innovators. Because these new innovators, I mean, if you think about the Swiss legislation on stablecoins, they actually need a banking license in Switzerland if they want to issue stablecoins, right? So we have very different approaches by governments. But as long as stablecoins rely on the banking industry, you also have a pass-through of anything that is risky in the banking industry back on stablecoins. And equally, of course, the counterparty of a stablecoin risk paradigm if something goes wrong with such an entity. So it is maybe not yet ready for high value cross-border wholesale. It is certainly becoming experimental for SME and retail, but it relies on a number of specific factors and specific use cases. Just to maybe surmise this conversation a little bit, I would like to hand now back to Kate, who hopefully will close this session. Thank you, Kate.
Thank you, Ruth. And thank you to all of our speakers. This was a really huge topic to try and tackle in an hour, but really insightful and an interesting conversation. So well done. Thank you everyone as well for attending today. If you have any questions, please contact Aisha Warris at thepaymentsassociation.org. You'll also shortly receive a survey on the webinar, and you can see the QR code on the screen now as well. We'd really appreciate it if you could complete this and provide your feedback. That's how we improve. You will also receive a follow-up email within the next 48 hours with a link to view the recording of today's webinar, which you're obviously welcome to share with your network as well. On behalf of the Payments Association and our speakers, thank you so much for joining us today and have a great rest of your day.
Thanks, guys. Bye.
Thank you.
Thank you.
Okay.